So today will be a huge one. This video will be the highlight of the A to Z guide because we will be going everything that you need to know in order for you to trade a market maker model. All the secrets, all the sauce, everything you can think of will be shared today. And of course, it's in my personal style, which means that it's straight to the point and it's cutting out a lot of bullshit that you don't need. The first thing that is very important to understand, because I have made a list in which I go over the certain steps that we need. And the first step on that list is understanding the context. I believe the context is everything. Now, what do I mean with context? With context, I mean that you understand where a market maker model will form. If you can understand where a market maker model will form, you can understand when order blocks will hold. You can understand when certain PD rates in the market will hold and push price higher or lower. Usually what you will see is that a market maker model forms only in a short period of time. And what I mean by that is that the highest probability price action is not always going to be there. There's certain moments in price that will be the highest probability price action. Will every day be high probability? No. Will every week be high probability? No. Will every month be high probability? No. It's picking out the right context in the highest probability price action. And that is exactly what I'm going to show you here, because that is where your market maker model will form. What I always tell people is it will feel like there will be more low probability days than there will be high probability days. So when you're moving from high probability day to high probability day, in between that, it's patience. Patience for new context to form. When you have the context, that is where you can go crazy. So on a technical level, what I mean with context, if we zoom out, and with zooming out, I mean going up in time frames. The more you zoom out, the easier the context will be. Because on a certain time frame, the context is just simply moving from discount array to premium array, or from premium array to discount array. Depends on if we're bullish or bearish. So if we take a look at this context on USD JPY on a monthly time frame. Now, I know you've all seen this before. If you've watched my previous videos, you've all seen this before, but this is a beautiful example. And this is also going a little bit over hindsight examples, but I'm also going to show you a live example, which was exactly a thing we forecasted in the weekly forecast as well. Right here on a monthly basis, we are moving from what? This fair value gap with this overlapping order block right there. Those are two discount arrays on the monthly time frame. So you might remember the question that I always ask myself: if we are going higher, where are we likely going higher from? Well, on a monthly time frame, if we are going higher, we are likely going higher from this fair value gap with that order block right there. Then what is our target? Our first target is what? It's this high. That is our first premium array. Eventually, we can also look to target that high, but that's not relevant for now. With market maker models and understanding the context, the thing that I always teach is that you don't actually need to look to the left. All you need is look to the right, because everything to the left here can be blurred. It can become white and it doesn't make any difference. Zero difference. All you need to know is the context, which is if we are going higher, where are we likely going higher from, and what is our target? And that is discount array to premium array. And you can imagine, because we're doing this on a monthly time frame, we have a lot of price action to work with. Now, if we combine the time frames correctly and we zoom in on this piece of price action, then in two candles, because this is 1, 2, in two candles alone, we can know where a market maker model will form. When you move from a monthly discount array to a monthly premium array, the time frame you want to be using is either a daily time frame or a 4-hour time frame for your market maker model. And this is the beauty, because the context is just two candles. You don't need a lot of candles to know what price is doing. With two candles, that is already my context. So let's zoom in to the daily time frame. Now you can see that on the daily time frame, we have our market maker model, because moving from this discount array to that premium array right there, in between that, this price action that is where you want to get involved. This is your market maker buy model. And the only thing you are doing is you are trading from a discount array to the first premium array, which was the monthly order block, to that monthly swing high. That's all it is. Then you can imagine if we go over context again, what do we see? We see the exact same thing happen on a daily time frame. For example, if we look at this fair value gap right there, then we can see that moving from that discount array with the overlapping order block as well, and targeting what? That first premium array, which is that swing high, discount to premium array. In between that, if you combine the time frames correctly again, from that discount array to that premium array right there, that again is your market maker model. This is exactly what I mean when I say you're combining the time frames correct. And you can see that all this price action to the left, that fair value gap, this fair value gap, is not really that relevant. The only thing relevant is, all right, where are we going higher from? That's the only thing relevant, because we want to trade this expansion higher. That's the highest probability. And in between that price action, moving from that monthly discount array to that monthly premium array, that is where, if you can, again, combine the time frames correctly, that is where your daily order blocks will hold. That is where your daily fair value gaps will hold. That is where your daily discount arrays will hold. Then again, if you go into this from that discount array to that premium array on a daily time frame, then here, if you combine the time frames correctly, for example, a 1 hour time frame, that is where your 1 hour PD arrays will hold. Now, what is the start of a market maker model? If you have the context, so we're using the context from that monthly order block to that monthly premium array right there, then on the daily time frame, you would want to see an ST. So that is just a fair value gap higher, which we get right there. That is already an early indication of what? Of the intermediate term low being confirmed. Now, this price action right here, this retracement, is not as high probability as the second fair value gap that we are creating right there. This fair value gap overlapping with that order block, that is your highest probability price action. That is where the fair value gaps are telling you a story. And the fair value gaps are telling you, yes, we indeed want to go higher to target that high right there. And all that is your new short-term range. So you're using the short-term ranges to get involved to target this intermediate term high. But that is your short-term high on the monthly time frame. That is why combining the time frames is so important. And again, this being a consolidation, that's not relevant. That's the least of your concern. The consolidation there is the least relevant. All you're doing is you're targeting this intermediate term high on the time frame you are entering on. So the time frame you are entering on, you are targeting an intermediate term high, but your context time frame is just a short-term high. The same when we look at this daily fair value gap to that daily swing high right there. On our context time frame, aka our daily time frame right here, we are moving from this fair value gap to that just singular high. So that is just a short-term high. But if we were to look at the 1 hour time frame right there, what would it be? Of course, it would be an intermediate term high. And then you use the short-term ranges on either the 4 hour, the 1 hour to get involved to target that intermediate term high. Now, the funny thing is, why is this context so important? Can you see this huge expansion that we had right there? And then we had a sudden retracement. On the daily time frame, this is a scary retracement because it looks almost like we're bearish right there. But all we're doing, if we were looking at the monthly time frame, all we're doing is coming back into a discount rate to continue the trend that was established on the monthly time frame. And how do we know the monthly time frame wanted to go higher? Because the fair value gaps are telling us a story that the monthly time frame is still bullish. We're just following the fair value gaps there. And this move is exactly what you need, because after an expansion, what I always talk about, you don't want to chase price. You want to wait for what? A new retracement. Because what does the new retracement do? It creates a new context from a new discount array to a new premium array. So don't be scared of retracements. Retracements are where new market maker models will form. For example, here, when we had this retracement, a new market maker model formed. When we had this retracement, a new market maker model formed. It's all fractal. And when we do have that retracement, that is exactly where you want to get involved. You don't want to look at instruments that have already been expanding. You want to look at the ones that have been retracing. So the same exact thing when we took out that high right there, that is our target. So what do we do after? First of all, the fair value gaps are telling us a story. Right there, above this high, does it seem like we are sweeping? Again, fair value gaps telling us a story. Right now, it does seem like they are getting respected. We are not wicking above that high. We are not aggressively moving lower. That is already the first indication that we might want to continue higher and target that high. Now, what do we need in order for us to target that high? We need new context. After taking the target, we've been expanding. We need a retracement. A retracement into what? Into a new discount array to target a new premium array. So we need new context. What you would do after your target has been reached, you zoom out. Zooming out again means going up in time frames. You go up in time frames because if you were to use a daily time frame here, it is difficult. Well, it might not be that difficult, but it's more difficult to navigate than if you were to use the weekly time frame. Because if we take a look at the weekly time frame, then we can see that it's just one simple fair value gap right there that we are moving higher from. Isn't that beautiful? And then the only thing you need to do is see that weekly fair value gap and say to yourself, if we are going higher, where are we likely going higher from? We have a weekly fair value gap there. Still, within the monthly context, we are expanding higher. Then that discount array on a weekly basis is where we want to look for potential higher prices. Then that high right there is what? That's our target. So between this low right there and that high, aka our target, this is our context again. And all we're doing there, all we're doing is predicting maybe 1 or 2 candles on a weekly basis. And those 1 to 2 candles on a weekly basis give us a lot to work with on the lower time frame. If you can understand what I'm trying to tell you here, the context, that is the most important part, because now you know where order blocks will likely hold. You know where breaker blocks will likely hold. You know where fair value gaps will likely hold. AKA, you now know where short-term ranges will likely hold. Because if we zoom in on this particular price action and we go into the 1 hour time frame, then we can see that on the 1 hour time frame, what happened after we took that target to the left right there. We can see that on the 1 hour time frame, it's very messy. It's very messy. And this is not above this high. The first time being above that high right there, all this price action, this is not where your breaker block will hold, where your order block will hold, where your fair value gap will hold. If anything, that is what? That is where price fails to follow through, aka your seek and destroy conditions. Then where will our new market maker model form? If we have new context, and that new context happens where? When we move from a new discount array to that new premium array. In between that discount array to that premium array, we will form what? First, an intermediate term high, aka our ST. That ST forms where? This right there, that small fair value gap, that is your ST. That is a very early entry. Now, is this the best entry? Is that the highest probability entry? Absolutely not. I think the longer you wait, the more you will get rewarded. What do I mean by that? The longer you wait in a market maker model, of course, you're not waiting until the target is hit and then getting involved. But the longer you manage to wait, the more patience you can have, you will get rewarded. Because that will be the highest probability. That will give you the highest win rate and the highest returns. Then right here, we see that ST. And what do we see after? 1 fair value gap, 2 fair value gaps. This is the moment where price is now confirmed to go higher. Because we have this new short-term range right there. Afterwards, what do we see? Short-term range right here is holding. Then after, we have this new short-term range. It's holding. After, we have this new short-term range. It's holding. After, we have this new short-term range. It's holding. After, we have this new short-term range. Will it hold? What are we close to? The draw on liquidity right there. Now, I do want to mention this, when going into the lower time frame, the kill zones, the news drivers, the day of the week, they all become more important. What did we mention again? When does price want to expand higher? When price has volatility. When is there volatility in the market? When there's news in the market. Price needs news to expand higher, which is exactly the reason why you saw this low being created when? On a Wednesday. What was the economic calendar doing on a Wednesday? We had US dollar news. And afterwards, we see again US dollar news and again US dollar news. So what can we expect? The volatility is right at those days. When the context is also there, because if we're trading blindly and we're trading in the middle of this seek and destroy range, then obviously the news is not relevant because we don't even have context. If we don't have context, we have nothing to work with. Now, the crazy thing is that even if you have just this weekly fair value gap, and this is again being way more advanced, but just by having that weekly fair value gap on your chart, it first off acts as a magnet and then it acts as a rocket because price will consolidate because it's seeing a weekly fair value gap right there. So price will do a consolidation here and then it will have some certain setups right there because it's targeting what? It's targeting the draw on liquidity, which is what? The weekly fair value gap right there. And then the weekly fair value gap acts as what? Once we reach it, it acts as a rocket. Why? Because now it's pushing it away. And you can see pushing price away, the high probability days right here, they are flying by. They happen quick. You either get in or you miss it. But the low probability days, again, these are what I would say, they are lower probability than these high probability days. They happen slowly. Price takes its time. It's moving slowly. It's doing whatever it wants. It is taking out the impatient traders. That's exactly what it's doing. And the impatient traders have already lost and blown their account in this price action before they can even get to these high probability days. High probability days don't happen always. You need to pick them out. If you follow the steps, the context, the news drivers, if the checklist is complete, that is when we have high probability days. And you can probably imagine that these fair value gaps right there, what are they doing? That is when we have on the lower time frame market maker models, because moving from this fair value gap right there to that swing high right there, this is exactly the same exact context as we just saw. In between that low to that high, this is where your short-term ranges on the 5-minute will hold. For example, if we take this piece of price action where we're moving from that order block to this high, that swing high, then from this low to that high, that is where your 5-minute short-term ranges will hold. So let's zoom in. So here we are on the 5-minute. This is our weekly fair value gap right there. We've been pushing higher and you can see that on the 5-minute, this price action is way more difficult to navigate. Here's where you would use even more so the intermediate term lows, the intermediate term highs. And you can see that if you just have one singular or two 1-hour candles that are moving from discount array to that premium array, then the context on the 5-minute becomes so much easier. For example, right here, we have what? We have this intermediate term high. Then we have a retracement into what? That breaker block right there. This already, that down candle is coming into what? That breaker block with an already confirmed fair value gap. Is that a perfect entry? Yes, it is. Now, does this need to be your target right there? You can use that as target. Yeah, of course, you can. But keeping in mind, is the RR right there worth it? Is that worth it? A 0.44? I don't believe so. So what you can do, because remember, we are in a weekly context. Because we're in a weekly context, we can go even crazier and target that whole weekly high, which is sitting right there. Now, again, I want you to understand me very clearly. Will these trades happen very often? No. Usually you will see a lot of losses, a lot of break-evens before you get a crazy runner like this. So just aiming for a simple 1 to 2 is all that you need. It's even more than you need. And you can see that every single retracement that happened on the 1 hour, this was this 1 hour retracement into the discount rate, the fair value gap with the overlapping breaker that is sitting right there. And it was a target, that swing high right there based on the 1 hour. Can you see on the 5-minute, this retracement is very confusing. So if you just zoom out and you make it easier for yourself, all you're doing is trading from that discount array to that premium array. And in between that, you are using this intermediate term high. That is where your ST forms. Then after we have a new fair value gap higher. We have this short-term range. These short-term ranges, they will hold. And you use them as your entry right there. All these short-term ranges are your entries. And again, a short-term range needs to have a fair value gap. Ideally, the short-term range should also come off of a previous discount array, but they need to have a fair value gap. There needs to be a fair value gap in the short-term range. Otherwise, it isn't a short-term range. Just to go over this one more time as well, where would you place your stop loss? You place your stop loss at the place where price has no reason to come back to. This right here, price has no reason to come back to. Why? Because this low, if we look at the 1 hour again, that low right there, that is where price already came into a previous fair value gap and already created a new short-term range higher. And because that we know short-term ranges will hold until we reach that intermediate term high, that weekly target, we know that price has no reason to come back there. And then after this target is hit right there, what would you do? On a 5-minute time frame, that's an intermediate term high. But what would you do? You do the same exact thing. You zoom out again. Because when you zoom out again and we go up in time frames, you can use the 50-minute as well. But if we use the 1 hour time frame, then right here we can see we have that breaker with that overlapping fair value gap right there. We have new context. And that new context, if we dive into the 5-minute, then that new context is already where our entry opportunities happen right there. So would you follow price after this entry opportunity has happened right there? Would you follow price based on a 5-minute time frame higher? You could do that, but you need to understand that is not the highest probability. That is actually pretty low probability, because a lot of times you will get caught in price action like this, where we come into that fair value gap and we just have a huge retracement lower. And what does it retrace into? It retraces into something that is on the time frame above it, because your 5-minute needs to be in context of your 50-minute. Your 50-minute needs to be in context of your 1 hour. So when we retrace into something on the 1 hour, you need to be aware of that. If you're just following the 5-minute time frame right here, your 5-minute structure, then you will get blindsided. And you can see here that every retracement that happens, don't be scared of it, because it's a new opportunity. It's a new market maker model. Even the smallest retracement, if you were to trade like the second time frame, the 1-minute time frame, then this retracement right there, for example, if you were to go into the even lower time frame, then this, from that discount array to that premium array, that is your context for a very lower time frame market maker model. And then in between that, all you're doing is what? You're waiting for that intermediate term low, which is your ST. Afterwards, you're waiting for new short-term ranges, which is exactly the highest probability price action where you can get involved in. After we reach that target, what do? You zoom out again. You go up in time frames and you wait for new context, because then right there, that is your order block, and this to that, that is your what? That is your new context. And that is where you would go into, I don't know, the 30-second time frame, the 10-second time frame. Now, don't make it that crazy. You don't need those second time frames. It's just as an example of how fractal this is. Because essentially what we've just done, we've worked from the monthly all the way down to even the second time frame, which is the exact same. All you need is that context. You constantly need the context. The context, I would argue, is almost the same as your entries. Because when you think about it, you constantly have the same context. Because here we moved from this 1 hour order block to that 1 hour premium array right there. Then for an entry, we are moving from this 5-minute order block to that 5-minute premium array right there, which is also your context. And after we have reached our target, we need to ask ourselves, and this is where the fair value gap video comes in. And the video I'm talking about is the fair value gaps are telling you a secret story. Because right here, we are on Euro GBP, and this is a beautiful example. If we again start off with the monthly time frame, that we can see that we are moving from this monthly fair value gap to the monthly low, which was first that low and afterwards this low as well, which is a clear swing low on the weekly time frame right there. So if we are moving from that monthly fair value gap to that weekly low right there, then on a daily time frame, of course, we will have nice moves and fair value gaps holding right there until we reach that low. Now, this is where the fair value gaps are telling you a story. Because if we go into the 4-hour time frame, what do we see? We see that once we reach this target, we have a very aggressive reaction. This reaction right there, based on the fair value gaps telling you a story, is this a reaction? And you can compare it to USD JPY, what we just saw. Is that a reaction that you would say, yes, I do think we are continuing lower? Well, we very well could, but not right now. We are clearly having a very aggressive reaction, and we are clearly seeing what? A market maker buy model in the making. We just came off of this market maker sell model right there, and now we are creating a market maker buy model. What can this market maker buy model reach for? This is a different scenario because now we are moving from an external range right there. We are sweeping liquidity to targeting something internal in the form of a fair value gap. If we zoom out, we first off have a few daily fair value gaps sitting right there, one small one right there and one right there. But what you're taking into account is the weekly time frame, because here on the weekly time frame, we are in the middle. We are 10 hours away from creating what? A weekly fair value gap. What have I told you before? 1, 2, 3. This candle is uncertain because we already had the expansion. Price is in for a retracement, especially after reaching a target. So that fair value gap acts as already, before it's even being created, that acts as a magnet for price. That fair value gap in itself is your drawn liquidity. The same as what we just went over on USD JPY. The fair value gap acts as a magnet and as what? As potentially a rocket. So if Euro GBP wants to continue lower, then it will likely do it off of that weekly fair value gap. So that weekly fair value gap in itself is a target, and it could be responsible to push price lower. Now again, that is where more knowledge as well comes in, because if we're sweeping this like this currently, then is it very logical for price to continue lower off of that? That is something we will discuss as well in the weekly forecast. So knowing that this is our drawn liquidity, that is the most important part right now. Then if we go back into the 4-hour, then right there, what are we seeing? We are seeing this ST, which is creating what? That intermediate term low right there. Then that ST is creating what? That small fair value gap right there. Then this small fair value gap on a 4-hour time frame, it's what? It's your new context, because we're moving from this low to that high. So if we go into the 15-minute time frame on that particular context, then here we can see we have no fair value gaps higher, but afterwards, what do we create? We have this fair value gap higher, and then afterwards we also have that fair value gap higher right there. These are all potential entry opportunities. And what are they? They are short-term ranges again. After we reach this target, what would you do? Well, to avoid ugly price action like this, where it's not that clear what it wants to do, etc., you would zoom out and you would look at new context. What is your context here? When we are moving from this 4-hour order block, even that 4-hour fair value gap right there, then what we could see is this kind of array, premium array, with this weekly fair value gap as your target as well. So that is an extra that you have. That is an extra drawn liquidity, an extra confluence. So right there, you can do what? You use the intermediate term low, which is your ST. Then you look for your short-term ranges and your fair value gaps, and you target that high. Now, again, that is not financial advice. And again, that is being very aware. It is also a Friday. Is Friday known as a trending day? What did we go over with the weekly profiles? Friday is generally not known as a trending day. So that is something to take into account. That is why all the videos, combining all the videos, it's very important. But you can probably see now why this is the highlight of the A to Z guide. And as well, what you can see is after we break it all down, that you don't need those labels. The labels itself are irrelevant. I could call it, for example, I don't know, banana smoothie number 2, banana smoothie entry number 2, and it would be the same. All you need to do is follow a step-by-step process, and the context is important. That is all you're essentially doing. Now, combining the swing grades, we went over in the previous episode as well. That is how you can get to certain entries and how you can get to a certain trading plan that you want to use. And you can see that if you're using the swing rates on the higher time frame and then also on the lower time frame, you can get to very high probability price action. Just a little reminder that today the enrollments are open for the masterclass. If you're interested, again, scan the QR code on your screen or go to wap.com/RYO. The enrollments will only be open for 24 hours. So tomorrow they will close again. If you do miss the enrollments, then of course the essential class is always open for you, or a lifetime package with the masterclass. Now, again, disclaimer, will this always work? No, there's a step-by-step process that you are following. But you still need to understand there needs to be work done on your side. It's not just that I give you this and all of a sudden you have a 100% win rate, all of a sudden you're a millionaire. No, it's about finding the right context. The entries are really easy. You can see the entries are not the point. And that is why I went over the context. Because if you can understand the context, that is important. Where these market maker model forms. I always tell people in the mentorship, the entry models you can click buy or sell. It doesn't matter as long as you understand the context that you are trading within, because it's the context that makes the trader, not the entry model. The entry model, choose one that you like. It's getting to the right context. That is the most important part in finding market maker models and in your trading. And this is exactly how you can form these contexts and how it's very fractal. You can make it as crazy as you want. So practice, 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 and practice makes perfect. And if you manage to actually stick to it, instead of now focusing on a new video where you have a new shiny object and you're like, oh, let me use this, then yes, I have very bad news for you. If you are one of those where you consistently see a new YouTube video or someone talking about something new, turtle soups, I don't know, and now you're thinking, oh yeah, let me use that because it looks way better than what I currently have, then I have bad news for you because you will never get out of that endless cycle of finding that new shiny object. You need to stick to something. And in the beginning, like we discussed as well, there's a losing curve. You're going to lose in the beginning. And if you don't lose in the beginning, you will later on experience drawdown. And that's where risk management also comes in. So be very aware of that. Again, enrollments are open. If you did like this video, I would appreciate a like, turn on the notifications, subscribe, do whatever you feel like doing. Share it with your friends, share it with anyone who needs to see this or who needs to hear this. And then of course, I want to invite you to the weekly forecast on Sunday. If you haven't watched any other videos on the A to Z guide, then I would highly suggest you to do so because they will help you a lot. All right, perfect. Thank you.